Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So we're just going to do another velocity banking review and also talk about what I call the velocity banking poker face concept that I talked about in previous videos. So if you don't know what that is, I started to think about this when I did presentations in real life, and I noticed that the audience, like they were really understanding what I was talking about, and then they would actually show no emotion afterwards when I talked about velocity banking. And I always thought that was really strange because if someone was telling you like, "Oh, pay off your debt relatively quickly," without really changing your lifestyle, just kind of make some tweaks to your behavior, I'd be like really excited. It's like telling me like, "Hey, I can lose weight without doing any exercise. I just got to change what I eat." I'd be like all into that, right? Like, because I hate exercise, and I tell you that as a former athlete for a certain period of my life, man, I hate sports. You know what I mean? So I've noticed this kind of also applies to this YouTube channel as well, right? So I'm just showing you this is the lifetime channel analytics for this YouTube channel, and I have in total about 424,000 views, and then 48,000 watch hours, and I've made about $4,000 in just ad revenue, right? And so I get plenty of views, and what's funny is that I don't really get that many comments, given the large amount of videos that I have and the large amount of watch time. So if you kind of take a look here, I get some comments, right? And I have, I think, what I would call a very engaged audience. But sometimes I think like I have an audience, an online audience that is engage in what I call the velocity banking poker face, right? And it's not a bad thing, right? I don't like go, oh, you guys need a comment. I don't really care about that. But I just think it's kind of funny now that I think about it, because like this video here that I posted yesterday has 357 views and 0 comments and 29 likes, right? So obviously there is engagement, but I just kind of find it funny how when I talk about this in real life, nobody has any questions, and in online, like there's not that many comments. And sometimes I watch other people's YouTube channels, like, whoa, you got a billion comments, right? Like you got a billion comments. And so if you want to just kind of do some math, right? So is it this one? No, it's this one right here. 48,900 hours. So let's just kind of do this. 48,900 hours. How much would that be in days? That'd be 82 divided by 24, right? So that's 2,700, 2,000, approximately about 2,000 hours. Actually, let me just do this. All right, so this is going to be A2 divided by 24. That'll tell you the number of days humanity has collectively watched the channel, and then the watch time in years would just be B2 divided by 365. And then so humanity has watched five and a half years worth of content from this channel. And I was like, huh, that's a lot of watch time. Yet not a lot of people comment. And I had to ask ChatGPT this, believe it or not. And again, sometimes you can steer ChatGPT towards the response that you want, but it really does give pretty insightful answers. So let me just go to ChatGPT. And then we asked ChatGPT here, why does my Velocity Banking YouTube channel have a high view count and watch time, but nobody comments? And now, obviously, it's not nobody, right? Like, I love my audience member who comments, aka, shout out to the cult. For those of you who are self-proclaimed cult members, wink, wink. Anyways, could it be Velocity Banking Poker Face, but online? And let's just read the answer.
It's possible. Here's why. Velocity banking often surprises people, especially if they've never encountered the concept before. When they see how debt can be rapidly paid off with strategies like leveraging HELOCs or credit cards, it can leave them stunned and introspective. That poker face effect might translate into silence online as they process the information rather than engaging immediately. Here are a few more reasons why you might see high engagement metrics without comments. 1. Educational content is absorbed quietly. Many people watch your videos to learn, not to interact. They may be taking notes or considering how to apply the concepts, leaving little mental space to comment. 2. Commenting requires confidence. Your viewers might not feel confident asking questions publicly, especially if they're unsure how to phrase their thoughts. Velocity banking concepts can feel complex, and no one wants to ask a stupid question. Number 3, passive versus active audience. Velocity banking attracts a niche but engaged audience. These viewers might share your video privately or bookmark it for future reference rather than commenting. 4. Call to action issue. If you don't explicitly encourage comments with specific prompts, e.g., what's your biggest question about HELOCs? People may not feel compelled to respond. What you can do to encourage comments. Ask specific questions. At the end of your video, invite feedback with open-ended questions like, does this strategy make sense for you? Let me know below. Create a safe space. Reassure viewers there are no dumb questions and that you'll personally respond. Run polls or challenges. Ask them to share their debt numbers or hypothetical payoff timelines in the comments. Pin a comment. Start the discussion yourself with an engaging or controversial take on velocity banking. If it is an online version of the poker face, encouraging interaction might break the ice and get them talking.
Right. So let's see how many comments this video gets, or if we're gonna get another velocity banking poker face, but the online version. And again, it doesn't mean nobody comments. And I'll be honest, like I'm not the type of person like I need 100 comments by tomorrow. It's not that at all. I just think it's funny that because if YouTube didn't provide me metrics, I would really have no idea that people even watch these videos. I would literally have no idea. But let me ask ChatGPT this. Can you summarize what velocity banking poker face is and what the reasons for it happening are? Right? Okay. So, um, again, every like nowadays, I feel like this happens to me as I've gotten better presenting. Believe it or not, like in the beginning, I kind of like struggled a little bit, but I felt like the audience was more engaged and was more open to working with me. But then nowadays, every time I do a presentation, it's like the audience is dead quiet. They don't want to learn more. But then we have the high engagement in the YouTube channel. It's crazy, right? But let me just go ahead and ask ChatGPT this. This is so funny. All right. So let me go ahead and play this.
PAH Velocity Banking Poker Face Summary. The velocity banking poker face is the stunned or shocked reaction people have when they first learn how velocity banking works. This happens because the strategy reveals a faster, more efficient way to pay off debt, something they didn't realize was possible, and they're processing the implications of how it could have changed their financial past or future. Why it happens. 1. Surprise and shock. The method challenges conventional wisdom about debt payoff, catching people off guard. They realize they could have paid off debt much faster if they'd known this earlier. 2. Overwhelmed by math. The numbers and financial calculations can feel complex, making them pause to absorb the information. 3. Internal reflection. People start thinking deeply about their own finances, wondering how the strategy applies to them. They may also feel regret or guilt for not managing their debt this way sooner. 4. Skepticism. It might sound too good to be true, so they hesitate to respond until they fully understand or research more. 5. Need for confidence. Some feel unsure about asking questions or discussing their financial situations, preferring to stay silent instead of admitting confusion or concerns. This poker face effect, whether in person or online, stems from the mix of shock, curiosity, and caution that comes with hearing a groundbreaking idea for the first time.
So I'm wondering about all of you. Like when I do these videos, does it shock or give you one of these emotions, shock, curiosity, or caution? Right? And then I think right here, this is a big one too, guilt or regret from not managing their debt this way sooner. right? Very interesting. Like like I said before, I literally would have no idea that most of you were this engaged unless I had YouTube analytics. Like I'd be, what's funny is if I didn't have YouTube analytics, I'd be like, man, people just don't watch my channel, and like very few people are engaged. I literally would think that, but YouTube Analytics is a very powerful tool. So I could come up to more accurate conclusion of what's going on with the audience, but it's all good. I love you all, whether you comment or not. All right, so yeah, 5.5 years, which is insane. I don't think people realize how much how many people have watched this content. But this is kind of like an addictive drug that because it's mostly like and kind of like ChatGPT said, you're thinking like, whoa, why did my parents do this? I think it's gonna save me so much stress and worries and anxiety about money because sometimes, especially when you're a kid, the way your concept of money just kind of indirectly comes from your parents. So little things like, hey, like your dad or mom not wanting to give you like a 5 or a 20 because that's quote too much almost makes you feel guilty about making more money. I don't know if you ever felt that before, but I certainly did, where it's like, whoa, like, is money the scarce resource that, we have to fight over? And then as you make more money, like, what do you mean, what are you talking about? The scarce resources is actual human beings who are reliable and can do the work for you. Money is everywhere, right? That's kind of how you tend to think as you make more money. So let's go ahead and do another velocity banking review. So what is velocity banking? It is a strategy to pay off debt with the help of a line of credit. So let's just kind of go over the same situation we went over as last time. Um, so two things we need to do velocity banking. Number one is a budget. So we have the budget here, and then we have to make sure that when we write down our expenses, we write down every single debt that we have. So in this scenario, we make pretty much exactly $100,000 a year. Now, believe it or not, $100,000 a year, especially nowadays, is really not that much. There used to be a time where it's like, whoa, you make $100,000 a year, but because of inflation, because the cost of goods have been increasing, $100,000 doesn't feel that much anymore, right? And you could easily achieve that if you get like a $50,000 salary, like two people in the same household with $50,000 salaries, and you'd be like, dude, I am still broke. I am still paycheck to paycheck, right? So let's just assume that we have $242 left in savings, okay? So list every single debt that you have, and the very last line item is going to be your costs for general expenses, food, gas, insurance, all that other stuff that you always have to pay for, okay? Now, what we're going to assume is that we have access to a line of credit. So what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again, right? There are different types of lines of credit. The only type of line of credit that like 95% of the population is aware of is a credit card, right? You swipe it, you pay it back, and then you swipe it again, right? And credit cards are cool. I have like 20 something credit cards. In fact, I applied for a new credit card today, right? Like I applied for a new credit card today. Let's see if I get it. But I have over $527,000 in credit limits. So you know, one of the things that we have to be aware of is that if we're in this situation, and maybe with this average American, I got to make it a little bit more serious, put some red background here, and some, make it seem like we're in the danger zone. Average American, right? For $242 in savings, no one's going to lend you a line of credit. Almost nobody, unless you get lucky, right? I'm pretty sure, like, if you ever get into a car accident and you didn't have insurance, somebody might insure you. I don't know. Somebody might. I'm pretty sure there are people who drive without insurance and they crash their car and then somebody gives them insurance. Is that something I would teach? I probably wouldn't. I'd probably teach you to get the insurance before you start driving. It's the same thing with the line of credit, right? So the only time we should get a line of credit is when we don't need it because banks don't lend money to people who need it, right? And like I said, I have $527,000 lines of credit, 527, and I got huge oodles and oodles lines of credit. But let's assume for now we have access to an $80,000 line of credit, and some people get like so skeptical at just about an $80,000 limit. And let me just show you this, right? I got a $280,000 home equity line of credit, 8%, 280, 280, right? 280, and then if you sum up all the credit limits I have, 527,000. So I'm just showing you things that I've already done. I'm not one of those people who is like, this is all theoretical to me, because I just learned this stuff for about 3 years and then finally applied it, right? And then it kind of gave me the confidence to actually teach it. Okay. But let's just assume we have an $80,000 what we call home equity line of credit. So the cool thing about this is it's so flexible, you can use it to pay anything. Cars, loans, or I'm sorry, loans, mortgages, student loans, credit cards. And so this is what we're going to call your main operating account. What that means is that whenever you get paid, all that money usually goes into the account, and when you have an expense, it comes out of that account. That's what we mean by main operating account. It's not something special that you have to tell the bank, like, call the bank and say, hey, my line of credit is my main operating account. What do I do? Like that, the bank was not going to understand what you're talking about, okay? But just want to make that clear. All right. So here's the thing. So we're going to do two things. Number one is that we're going to have $6,000 same income. But number two, this is really important, is that we're not going to have any savings. No savings, but we have something called cash flow. Income minus expenses. And let me go ahead and copy those expenses. And then you can see right here, like, you might be thinking this savings number and this cash flow number is exactly the same, right? This is exactly the same. This makes absolutely no sense. How do you have no savings but cash flow, right? And I'll just show you right here, and I always show it all the time. This is what I mean by no savings but you have cash flow, is that whenever you get your statement balance for your checking account and it starts at zero, it should pretty much end at zero, right? Because what we're doing is taking all the money that comes in and then applying it to debt. That's essentially what we're doing, okay? So we're going to move some debt, and the easiest way to figure out which debts to move is using something called the cash flow index, right? So I'm quickly just going to demonstrate what that is, right? So think of it as like a ranking system. So cash flow index, and all you got to do is take the statement balance, right? Statement balance divided by the minimum monthly payment. So it's like 15,000 divided by 487.5, right? And then I'll just do this and the mortgage, 220,000 divided by 1319.01, right? So think of this as a ranking system, and if it's a lower number, that's the one you want to pay off. So just kind of like a quick cheat code. Credit card, high interest rate credit cards, and also short-term loans fit in this low cash flow index category. And so, like I said, the lower the number, that's the one you want to move the debt and pay it off in the line of credit. You recover cash flow, and then you follow that debt payoff order, which is incredibly important. But for some reason, a lot of the velocity banking teachers that I've seen online just kind of forget that part. Okay, so let me do that. We skip that. So let's go ahead and kind of do that cheat code of moving the higher interest rate credit cards to the line of credit. So this is going to be $52,000, 52,000. Again, think of it as like a debt transfer or credit card transfer, but guess what happens to this money? Whoa, or at least these payments, they go to zero by just transferring the debt, right? So we literally went from $242 to $1,934. Okay, $1,934. Okay, so next step is that we put our entire 6,000 into the line of credit, and then once we have done that, we take out our expenses accordingly. And so every single month, the cash flow should be the amount that should be used to reduce the balance on that line of credit. Okay, so now let's go ahead and do this, and we get the next month's balance, which is based on the previous month's balance, previous month's interest minus our cash flow, 1934.81. And then the interest is calculated by the average daily balance. So we have a way to estimate that with this average function, right? We get the average. The interest is not the average, right? So that would be insane to pay 51 grand of interest on a month. And if you multiply by 8%, that's the interest rate, but that's still not the interest, because paying 4 grand of interest a month on a $50,000 balance is insane. So what they do is usually they divide it by 12, which is the monthly interest, because it's calculated monthly. And so the interest is a lot more reasonable, right? And so now we just rinse and repeat. and then rinse and repeat, and then you just kind of keep doing this over and over again. And actually, with this one here, I think we can include the auto loan. I kind of forgot about that because the auto loan, and I'm assuming this is a used car loan, is at a higher interest rate than line of credit. In general, we're okay with moving higher interest rate debt into that line of credit. Should be fine. Okay, so let me go ahead and add this auto loan, right? So let me just do this 17000. Okay, and then we actually get this cash flow as well. So now actually a cash flow is $2,312. Wow, that was easy, right? So let's go ahead and update this. So 2312.96. Okay, so let me go ahead and copy and paste that. All right. So we're paying off all of our credit cards and our auto loan with a line of credit, right? And we see it takes us 34, whoopsie, where'd I go? All right, 34 months to pay it off, right? So let's go ahead and highlight that. And I'm going to highlight this, and we're going to do the red color font. Okay, so we did that, and then so it's 34 months to pay off. So 15 plus 27 plus 10 plus 17, 69K. Wow, that was so easy. So a little bit less than 3 years to pay off 69K. So, I mean, think about this. This auto loan usually takes about 5 years, and this, including our credit cards, was paid off in less than 3. Not bad, okay? Not bad, right? All right, so now we got to figure out the cash flow index of the student loan and the auto loan, which we have in our loan calculator. So let me go ahead and get that pulled up. So we have our loan calculator right here. And all we got to do is just kind of type in what month it is. We already paid off the auto loan just by transferring it into the line of credit. Let me go into here. And then this is 33,000, month 34. So I just type in 34 months into the loan calculator. 34, 34. And then we see right here, this is the current balance. Cash flow index is 69. So I'm okay with moving it to the line of credit, even though it's technically above 50. But because the balance is relatively low, even though we don't get that much cash flow, I think we should be okay. Although technically, like if this were my real life, I probably wouldn't move it to the line of credit. I would just do what we call the chunking method, which will demonstrate for the mortgage. Much easier to demonstrate that for the mortgage, but let's go ahead and do this. Plus 25587.21. Okay. So what we did is we moved that student loan into the line of credit. And so this is now our new cash flow, right? That student loan now goes to 0. And let's see how long it takes to pay off that student loan. Okay, and values only, and then we'll just do this. And so let's replace our cash flow 2680 point, I think it'd be 99, right? So round up. Okay, and let's go ahead and copy and paste. Copy and paste. All right, and so now in 44 months, we paid off the, let me just do this. Okay, so now in 44 months, we paid off the student loan. Okay, so now that would be 69 plus 33, that would be 102K. So 3.67 years to pay off $102,000. And you notice that as you get further and further into the debt payoff, each subsequent debt gets paid off faster just because we're just increasing our cash flow. Because remember, we started at $242 and now we're over $2,680, which is insane, right? So now that we're at 44 months, I'm just going to quickly demonstrate this. just remember it took us 44 months. We paid $47,000 of interest, and how much principal did we pay? Well, to calculate that, it's the original balance minus the latest balance. So we'll just do 220 minus 209. So, whoopsie, 220 minus 209. So we paid off 11K of the principal, which is just basically the loan balance, right? So this is the bank's profit until now, and this is the actual loan that you paid off for the 6% loan. And if you don't know about how amortized loans work, if you go into the final term of the loan, which is going to be 360, right? Look how much interest you paid, $254,000, and the loan balance was 220, so you end up paying 574,000 in total for that loan. Isn't that insane? Oh my goodness. All right, so now let's just kind of do a quick comparison here. So let's say, rather than going with the bank schedule of just making what we call the monthly payment, but you could also think of it as the minimum payment, although a lot of people don't think about loans that way. It's technically the minimum payment, but it's like a fixed minimum payment, right? And if you ever pay more into it, you can't really get that money back. It's much less flexible. But let's go ahead and take a look at this, okay? So if we move $11,000 into the line of credit, how long would it take for us to pay it off, right? So if I just do this right here, and I do plus $11,000 just to transfer of the principal, how long does it take to pay off? Well, blam, 4 months, right? And then we just do it again, and then 1, 2, 3, 4, right? See how easy that is? Wow. So 1, 2, 3, 4. And so you can see, right, it takes us 4 months to pay $11,000 off, right? So when we transfer the principals into the principals, not print, what am I saying? Principal balance into the line of credit, 11,000. It only takes us 11 months to pay off that 11, or 4 months to pay off that 11K in principal, right? And what's 44 divided by 4? It's 11. So if I do 4 times 11, right? And then, oh, this font is so silly and small. Okay, so if I do 4 times 11, right, that's 44. And if I just do 11 times 11, right, that's 121K. So according to this, if we just keep going for 44 months using this method, we'll pay about 121K in principal, right? So isn't that insane? Now, here's the thing. Here's the part that's tricky, why it's so hard to calculate this correctly. It's because after every single month, you're still making the monthly payment, right? So it's a little bit hard to calculate, but if you're just doing like extra payments on a let's say like a mortgage spreadsheet, you'll notice the numbers are relatively the same. Okay, so it's just kind of a different way to get there with an extra payment, but it's not like I think a lot of people will say like this is the most completely different thing. It's not. The way that I think about like this whole chunking method and using a line of credit to pay off your mortgage is kind of like the like what's the value in the strategy? It's the fact that you're actually going to do it, right? So the way that I equate extra payments is kind of like a New Year's gym membership or term life insurance. And I don't know if you ever like heard the statistics, but like term life insurance only pays it like 2% of the time, which is why it's so cheap because they know they're not going to pay out, right? And the way that I also think about extra payments is the same deal. Like, hey, that's the available option to you. So if everybody knows that they have that option, why haven't they paid off their loan? Because the cash flow management becomes so hard, so much harder, right? I don't think people understand that, but I'll go over that in a maybe in another video some other time, probably tomorrow. Okay, so let me go ahead and open up that velocity banking calculator. Give me one moment. All right, there we go. So this is a velocity banking calculator by Renatus. Some people have been asking, where do I get this calculator? Well, I sell courses for 1,000. How much is it? Like 2 grand to 20 grand. By Renatus because I sell their resell their courses as an independent contracted marketer. And so, if you want to spend 2 to 20 grand, feel free to fill out the Google form link below. And people are like, oh my goodness, I would never spend that much money. And then I'm like literally showing people strategies about like how you can easily like make millions of dollars. And again, these are demonstrations, so there's no guarantees, obviously. Within like a 10-year span with like little to no effort, and that they wouldn't pay the 20 grand to have a foundation to learn a lot of this stuff. And not only that, an opportunity and chance to join this cult. Oh wait, did I say the quiet part out loud? But anyways, so this is a velocity banking calculator, and so what's cool about this is that you can just type in the numbers and it'll just spit out like the payoff time, the amount of interest that you pay, and how much goes into the line of credit. So you don't have to use like huge numbers. A lot of people think, oh, like the bigger the chunk, the better. Not really. Like you can just use a reasonable chunk. And so let's say I do 10,000, right? 10,10,000. This will actually go up a little bit, the interest that we pay, right? See that? 34. And if I do 6,000, it's like 30. Oh, did my thing freeze? Well, it's still 34. Did I screw up? I don't even know. Let me just do 10,000 one more time. Sometimes if you have the velocity banking calculator open, like everything seems to slow down for some reason. And I kind of know why. So 34, 261 and 34,441. So you can see there's barely any difference between a $10,000 chunk and a $6,000 chunk. I'm so sorry. Well, I don't even know what's going on with my throat. But here's the thing. If there's a huge interest rate difference, you definitely don't want to move the line of credit into, or I'm sorry, the loan into a line of credit, meaning like doing a first lien HELOC replacement. And just typing the numbers in can really show you the difference between like, whoa, like, did I really want to replace my 3% mortgage with the line of credit? And some people have done that. I saw a comment about that recently. I was like heartbroken. I was like, the person regrets it. And I actually had emails about that. Like, should I do this? And again, I don't give you financial advice, so don't email me asking for financial advice. I just do these demonstrations. I'm like the guy who goes into Costco and it's like, hey, here's the sample, right? Like, do I care if you like the sample or not? I'm just giving the sample. It's my job, right? At least in this YouTube channel. And so if you take a look here, this is like really detailed, like of all the calculations. And I didn't come up with this. There was a guy named Randall, who's the velocity banking instructor for Renatus, and really smart dude. Okay, so you take a look here. Oh my goodness, like look how detailed it is, but I don't want to look at that just because it's information overload. So let me go ahead and just copy this part, the 5.1 years, and let me do that. And if I just do this, this is going to be 5.1 plus 44 divided by 12, which is 8.77 years debt free. All right. All right. And hopefully, you know, you got some, your brain waves are being stimulated, right? And I know, and to be honest, I kind of think like the poker face is actually like a compliment in a way because maybe you are shocked, right? Maybe you are like curious, like maybe you're like, why didn't anybody teach me this before? And the reason why nobody taught you this before is because if everybody actually started doing this in mass, which is pay off their debt early, they're going to be like Wells Fargo, okay? So Wells Fargo built card losing money, okay? So if you don't know what the Wells Fargo Built Card is, it's basically a credit card that allows you to pay rent. And so this is like what I call an accidental velocity banking credit card. And so if you look into it, like they actually allow you to pay rent and give you rewards points for it. Now, I think in their mind, this is what they're thinking. Oh, they're paying their basic expense rent in that credit card. Okay, they're paying their biggest expense. So they're obviously going to leave a balance. And what people were doing is because usually, a lot of times, what happens is that these kind of cards attract more savvy people. They pay their rent, they put their other expenses on there, and they're like, well, I'll just dump my whole paycheck in there, which is a Velocity Bank credit card. And as you can see here, they're losing 10 million per month on the card. 10 million per month, right? Built credit card, look it up. So that's probably why they never taught you. And this is now going to go to zero. All right. So zero mortgage. And now it's $4,000 cash flow a month. Okay. All right. So hopefully this was insightful. And I don't know if you got any comments you want to tell me below. And you might think like, hey, I'm a poker face dude or gal, right? I've been watching these videos and I just don't even know what to comment. Just comment that, right? And if not, no worries. I still love you. Okay. So this is Karina Anti Mentorship. Have a great day. And again, if this is shocking to you, it wasn't even shocking to me. You know why? I'll tell you something. When I first learned this, I made 20 grand a year, and so I was like, well, I'm never going to use this because I made 20 grand a year, right? And then eventually, but what I did is I had that mindset that this will eventually become useful to me as I make more money. And so when I got my mortgage, I applied the strategy and paid off $58,000 under 1 year. And then, stuff happened, and then I paid off my. Oh, is it even showing? Hold on a second. Where's this image? Can I make it reload? Let's see if it reloads. Oh, okay. Yeah, let's do that. Oh no, is my internet down? Well, okay. So as this is okay, it's finally reloading. So let me just show you how long it took me to pay it off. And again, hopefully you're not sick of this if you're a longtime viewer, but I paid it off under 3 years. Well, it looks like the picture's not even loading. Whatever. So spoiler, I paid off my mortgage in 2 years and 9 months. Oh, there we go. There we go. 2 years and 9 months, right? 2 years and 9 months. It's all good. So I'm mortgage free. Okay, well that's it, everybody. Well, technically not because I got a first lien HELOC, but I'm technically uh, still have a mortgage with the first lien HELOC, but I'm mortgage free in the conventional sense that most people understand it. All right, well that's it, everybody. So have a great day, everybody, and we will speak next time. So good night, and what's my last words? I love you all.